Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
All right. Well, good morning. Happy New Year, everyone. It's 2025. As we record this, it's January 3rd. This will probably come out mid to later January just because of the timing of the podcast. But thanks so much for tuning in to the Millionaire Next Door podcast. We've had a great run throughout 2024. We're going to keep it going in 2025. We have a terrific guest today. This is Miles Clark. He's a research analyst with Nasdaq Dorsey Wright. They've just released a report this week, a review of the second quarter of 2024 and themes for the first quarter of 2025. I definitely want to focus on the themes going forward. No one wants just a rehash of what's happened. They want to know what's going to happen or where the puck is moving to. There's no one better to do this, I think, than Miles, who's been on the podcast before. So welcome, Miles. Thanks for being here and Happy New Year.
Yeah, I appreciate the warm welcome. Certainly happy to join in. I know it's been just about a quarter or so since I was in last time. I do have to ask, am I the first recorded guest of 2025?
Yes.
Well, that's an honor. What an honor.
You're kicking it off here.
Yeah, well, that's certainly no better place to start than, like you mentioned, just the quarterly report and really what we're seeing from a technical perspective. Maybe just a quick background on myself for those of you who might have missed the previous podcast with me on there. Like I said a couple of months ago, again, it's Miles. I'm one of the research analysts with Nasdaq Dorsey Wright. We're based out of Richmond. We specialize in technical analysis and momentum-focused trading and things along those lines. So again, we certainly appreciate the fundamentals. We know that some of you who are listening, probably the majority of you who are listening, are going to be focused on fundamentals. Of course, we're going to specialize primarily in technicals, and so allowing price and really the markets to tell us what's in favor from a relative perspective is kind of our bread and butter. And so that was kind of the origin and genesis of this quarterly report, which we called the weight of the evidence, which is really just where's the weight of the evidence as we move into the next quarter, into the next year, and kind of go from there.
That's terrific. I love that as a theme because we're always looking at that too. Weight of the evidence. It's a very disciplined, objective, unemotional process. What is the data telling us? And just to frame it, but I'll let you go. I mean, we are at a time of change, right? We've had a big couple of years of a bull run, maybe a much better year than anybody would have thought in 2024. We are through the election, which was, a big deal. But a lot seems to be changing, globally, or maybe it's not. Maybe some of these trends are just emerging, and you really have your pulse on that. So that's why you're weighing the evidence rather than some emotion or intuition. What is the data really saying? So I'll let you, continue to launch into that.
Yeah, I mean, I'll start off with really what hasn't changed, and that's really just markets putting together another really, really, really good year. I mean, we look at the top three areas of the market from just a kind of a broad sector or broad kind of core or group focus. You see kind of the top 50 XLG, the Nasdaq 100, then just the core S&P 500. Really leading the way throughout 2024, and ultimately that is the exact same theme that we saw in 2023. So, it just conversationally, for those of you who are keeping track at home, this is now the second consecutive year of back-to-back 20% gains for the S&P 500. I did a statistic on this in this quarterly report. If you go back to 1930, that's happened 4 times, right? So it's extraordinarily rare. And I'm certainly not naive in saying that we would expect that trend to continue on into 2025, right? Past performance is no guarantee of future results. I think that's everyone's favorite line. But from a momentum perspective, it really is a domestic equities and markets in general are still on really strong footing. Now, there is some stuff that we want to mention and watch out as we move into 2024, or excuse me, 2025 now. But yeah, there's markets are still really strong, and the core of the market's still incredibly difficult to beat right now.
Yeah, that's so true. There's these terms that come to mind when we view it with perspective, climbing the wall of worry. I feel like last year where there was no shortage of worry, yet the market just climbed right through that.
Mm-hmm.
And
Yeah.
and the momentum is sort of the direction. You talk fundamentally or the physics, right? That law of the object staying in motion until it's acted on by an equal or opposite force. And, it's still that momentum carries it forward. It's a big deal for it to change. And we usually see signs of things changing. So that's under the surface, things that we're sort of parsing out. So maybe a number of things are just continuing the way they were. And that's
Yeah, and I'll mention like when we talk about momentum, right? We're talking about winners, not to cut you off there, but winners, right, continuing to win. And perhaps more importantly, I think you and I chatted about this briefly last time too, but you have your losers continuing to lose, right? And so you have to think about the way these momentum strategies actually work, right? And let's just start off with it with an equal weighted basket, right? And so where momentum wins is it essentially says, hey, these stocks are really strong. We're going to overweight these. And that makes sense. And then on the other side, you have weak stocks, right, or weak sectors. And it says, okay, well, we're actually going to underweight these guys. And that makes sense. And so when you have those trends really persist, really for the better part of the last 2 years or so at this point, technology, industrials, right, consumer cyclical or discretionary names, these trends have, these stocks have done well for the better part of the last few years. On the flip side, energy, healthcare, consumer staples, some of these kind of risk off sectors, if you will, continuing to do poorly. It's been a really, really strong year for momentum, a really nice rebound after what was a pretty lackluster, I may add, as a chartist, right? I'll say it was a lackluster year for momentum in 2023, really following that up nicely with a nice year in 2024, which I think we can all be thankful for if we're following momentum.
Oh yeah, 100% thankful. But yeah, it is so interesting. Certain areas you talk, it's definitely been risk on. You saw the financials pick up. There's obviously things that just continue to stay weak, like energy. It feels like it should be a buy, but it just does not have the demand there for it. So, um, it's
Yeah,
a
yeah. I mean, that's one of those areas which moves around quite frequently. Like we use our Dolly rankings, which for those of the kind of the uninitiated, what we call the dynamic asset level investing tool, and that we use relative strength to essentially say what areas are strong right now, what areas are weak right now, right? That's kind of the key in. And so we can do that from a broad asset level perspective to say domestic equities are strong, commodities are weak, the cash is weak, whatever it may be. We can also do that underneath the hood for sector perspective. And so that's what I was talking about with those rankings just then. Energy has ranked in the bottom half for the better part of the last few years, ever since 2022. And you've seen, little fits and spurs where you've seen it move up. We call those in the business little laggard rallies that we like to sell. These are ones that they're not real relative strength, right? This is just little flashes in the pan that is best to probably avoid. And that's the important part about staying objective in this type of stuff. A lot of us, myself included, if you've got clients and people at home, they watch the news, right? And they see, oh, this sector is up today, or oh, the S&P 500 is down today, right? It's very easy to get caught up in the idea that this is what I should be buying because everyone is buying it, right? Versus having an objective rule set situation that you say, oh, well, this is actually a real buying opportunity. This is something that I shouldn't touch just because it's actually not a legitimate rally, if you will.
Yeah, that is so true. So, we have often commented on a big part of my process is helping clients like tune out that noise, the unnecessary noise. I've literally spoke, some clients just listen and we're following this stuff all the time. So we're seeing it with the perspective, with in partnership with you guys and with your help. But so most clients go along with that. Some folks, I could literally hear them talking with, CNBC in the background. So they're hanging on every, the last 30-second soundbite that, was only partially given and missing all the context and acting on that and feeling this fear of missing out, or you got to get in on this. And it's just, it's not a great way to run things in the long run, but I think a lot of people fall into that. And we feel we're adding tremendous value by really having a defined, well articulated process. But I'm sure you see it that way as well. But,
Yeah, I mean, certainly. And I can think of one thing. We didn't plan to talk about this in the quarterly report or the podcast today, but, I can certainly think about, maybe some sound bites that might be coming up in the next year or maybe even 4 years, with the results of the presidential election. So I know people like to watch that and everything, but I'll, do a brief callback to our last podcast where we talked about really markets don't seem to care who the president is. And of course, we have our result now, with President-elect Trump. Democrat or Republican, markets have had extremely strong years. They've also had their fair share of extremely bad years. And so, it's not to say that historical data can't be of aid, but you kind of look at it and you say, well, what's most important, or actually what's most concerning, is uncertainty in the markets. And so markets know, who the president is at this point. Now, of course, what comes out of his mouth, or really what happens from there, who knows? And I'm certainly not trying to get political at all here. I want to emphasize that. But you kind of say, well, uncertainty could pop up. That's when markets could get a little bit weary, if you will. But just because who's in the White House, at least, doesn't really seem to have that much of an impact, historically speaking. So
yeah, it's I've been doing this, I think, something like 26, 27 years now. So we've seen of a lot of elections, and it's always seems to be a big deal, but markets just sort of, they do what they're going to do, so they, so far the response of the market has been pretty good to the election. I mean, it seemed to like it, but just hearing different people with their political views, or the ability to separate that from what's actually going on in the market, that's sort of, it's not connected to that. And then to the extent that people who get too caught up in their emotional views on it or their worries, a lot of times they just miss out on opportunities that cost them a lot of money. And that's
right.
really unfortunate. So
It's very difficult to do, is to separate church from state, if you will, kind of at home, and kind of what your political beliefs and your investing beliefs. The idea is, and there's been plenty of wonderful books and things like this, is really just pays to continue to buy. Of course, then it also pays to have some technical overlays that tell you what to buy. But there really has been very few instances in history, barring a select few, which I think we both know, but where it's paid to really stay out of the market for too long. So if I had a piece of advice on the presidential stuff, it's just continue to watch. Of course, volatility could creep in with some things that are said or done, or different policies, things like that. But in most cases, at least from a historical perspective, like you just mentioned, Robert, it doesn't seem like it really matters, to be frank.
Yeah, and what else? Were there other key observations worth pointing out of the whole report you did, or what really jumped out at you?
Yeah, the main thing, we've been talking a lot about how markets are really good. I want to mention one particularly concerning part that myself and the rest of the team are watching as we move into the new year is participation drying up. Now, I hate to keep calling back our previous podcast, but I think we actually did a pretty good job of talking about it. I mentioned before kind of this idea of an army, right? And if the general is at the front and he doesn't have an army behind him, well, the general is going to die on the battlefield, right? And so we can do the exact same thing with participation, this kind of idea of, well, if there's only a few stocks leading the market higher, that's typically, a particularly perilous situation for the entire market to be in. Now, over the fourth quarter, participation stocks in positive trends, the good stuff, right? Those were moving higher. December saw that participation fall out of bed. And so as we enter the new year, we're actually at participation lows that we've been at for really the past couple of months or so, which I think is a concerning development. The overall picture is still pretty strong here, but it's something that I come in to my desk each morning and I look at where's participation standing at, what are things looking at, how's the average stock doing, and things are starting to roll over, which is I'll say again concerning.
Yeah, I remember this conversation really well. Like last year, it was all magnificent five or seven or maybe five stocks, right? And where was the participation elsewhere? The market didn't really care. So
Right.
that was a big issue. And then it sort of broadened out, and now it's waning. And then, one thing maybe worth talking about, those weak areas. A lot of people want to buy really cheap stuff, but I've found those areas that are super weak in a generally strong market. I feel that to be a pretty hefty red flag. I don't know what thoughts you have on that, but
And when you say weak, are you talking about sectors? Are you talking about style groups, kind of the whole 9 yards?
kind of the whole 9 yards. It could be a style group, it could be a sector, could be a stock.
Okay.
It's so yeah.
Yeah, I mean, momentum is built on. Now, you could ask a different analyst this question and probably get at least four different answers. But for part of momentum is going to be the idea that winners keep winning, right? And so, what has led the market higher is going to continue to lead the market higher until it tells us otherwise. And interesting, actually, glad you asked this question because we saw an interesting relative strength development for growth versus value, and growth using a growth representative versus a value representative moved to its highest level of relative price against value over the last 4 decades. Now, there's a lot of jargon in there, but for those of you who aren't acquainted with it, point being is that growth is really expensive compared to value right now. But the idea is for other analysts, that would be a negative, right? Well, let's go buy value, right? For momentum, it's going to be the exact opposite. It's going to say, hey, this is breaking past a key resistance point. Growth can continue to run here, right? And so that's the idea that's going to be in play with a lot of this stuff is what's winning continues to win, what's losing continues to lose until trends tell us otherwise. Momentum is never going to be the first one in the party, and it's never going to be the first one out. It's always going to be a little bit late at the very beginning, and it's always going to be a little bit late. It's never going to time the top perfectly, right? Because essentially we have to wait for those trends to confirm. And so that's that main idea. But point is that that's what momentum is built on. Winners win, losers lose.
Yeah, really powerful. And when you're saying the sort of drying up of the participation, are you saying up on the value side that's drying up and it's still pushing heavily into growth? Is that what you're seeing at this time as we recorded?
Yeah, value, the big area that's starting to dry up a little bit, which I think is particularly concerning, is small caps. We have seen small caps improve a number of times, led higher mostly by regional banks and financials, which are a point of strength from a sector perspective. But things are starting to, dry up a little bit from the small caps perspective, from the value perspective, and it's moving back towards, let's just say, the flight to safety growth stocks, the Magnificent Seven. You look at the cap weighted S&P 500, besting the equal weighted S&P 500 by about 13% in 2024. A lot of that came in the last month, in December. Right. And so, you're seeing this rotation out of the other 493 into those seven again, which again is a bit concerning in my eyes.
Yeah, we lived through that was so much symbolic of 2024. It just felt right. It just kept going and going. And we're back. We're sort of right back there, is what you're saying. A little bit.
And on the flip side, like for those of you who want to kind of paint this in a positive light, participation isn't everything, right? It is important, but it isn't everything. We've seen most recently in 2023 stocks being led higher by just 5 to 7 names or so. So it's certainly not like I'm sitting here saying just because participation is low, that means that stocks have to go down. That's not the case, right? It's just you would rather see more stocks moving up than you would rather, than fewer stocks, if that makes sense.
Right. And then, I do want to make mention, and your report covers it and your whole process. It's not just all stocks. We've been talking about stocks, but you're following all the other asset classes that can be populated in a portfolio that matter, fixed income, international stocks, commodities, God forbid, even cryptocurrencies, right? Getting a lot of,
Right.
you know, uh, any comments on those asset classes that are worth keeping in mind, or just
Yeah,
curious
I'll start
what you're
with
seeing.
fixed income. I'll
Okay.
start with fixed income because I think this is an area that a lot of us are saying, okay, well, fixed income is relatively weak and it has been. But for a lot of your clients and a lot of the clients who are calling us as well, it's not as particularly as practical just to completely avoid fixed income. For instance, you could say, okay, well, commodities aren't doing that well. And for a lot of clients, it's practical just to say, okay, well, we just won't have any in our portfolio, right? But for a lot of us, having fixed income in our portfolio is really important because of our age range or our certain goals that we have in mind for our financial future. So you look at financials, or excuse me, you look at fixed income, excuse me, and you say, okay, well, what is relatively strongest within fixed income space for the exposure that I do need to have? And that's where relative strength can really, really help out. Not only knowing where stuff is that's strong within the strong asset classes, but knowing what's strong in the weak asset classes. So again, domestic equity is very strong, fixed income relatively weak, but what's good within fixed income? Well, those areas that are kind of less rate sensitive, right? So floating rate areas, convertible bonds, kind of the preferred securities, those types of areas are doing particularly well from a relative perspective. Longer duration options there, they're not doing as well, right? The kind of rate sensitive areas, they are not in kind of stable footing. The core of the bond market is not doing particularly well right now. A lot of the other areas outside of the core are points of relative strength. I know that was a lot there, but that's the general picture.
Yeah, no, it's super helpful. And with your guys' help and my, I have a pretty deep involvement in what you guys do and your process. So I share that with a lot of clients. It just, as I'm sitting here kind of thinking through it, a lot of it is really about just stacking all these odds in one's favor of making more correct decisions. Momentum's generally going to get it right. I don't know if you have a thought of that. But I think I'm a tennis player too, and I've studied. We play tennis every weekend, and I know like each point, some people get so caught up in each point, but I'm absolutely shocked to learn, if you look at the data in tennis, you really only have to win a few more points than you lose to come out an overall winner. And this is even true of one of the greatest players of all time, someone like a Roger Federer. If he won, he might have won 52 or 53% of his points. He lost a lot of points in a lot of games, but he still is one of the most dominant players ever. So, he's very process driven. We're process driven. This may seem like a diversion, but in my mind, that's kind of how I look at some of this stuff, is just stacking probabilities and having a defined process and watching what goes on and using that data to guide those recommendations and decisions. Don't know if you have a thought around that. It's kind of a long thought there, but
No, yeah, certainly. I mean, that makes a lot of sense, and that's why we call the piece the weight of the evidence, right? I mean, it's about finding ways to, if you say, okay, well, you don't need to win them all. Actually, in terms of momentum, you actually don't even need to win half. Momentum, in terms of a return profile, most momentum trades are actually unprofitable. It's the few streaks, if you will, that a tennis player would go on. It's the few streaks at the right time, or it's the big winners. It finds its areas of relative strength that actually give momentum the pop over other asset classes. Momentum is going to buy something that's up 300%, that's up 500%, that actually ends up going up 1,000%. You ask a value investor to touch something that's up, 200% that year, they're not going to include it. And so that's where the kind of difference between factors steps into play. And again, it's not stacking the weight of the evidence, stacking the chips as much as possible on your side, so that way you can figure out what's going on. And to the flip side of that, because there's a lot there to unpack. The flip side of that is knowing when to sell, right? I'm sure that the best tennis player knows when he's down 0 to 40 in the match, he's probably not winning that game, right? No need to expend energy on those points on those points trying to win that game. Cut the loss and call it a day, move on to the next game and win that one, right? Momentum does that really well, where it says, hey, we're down 0 to 40 right here. This was a losing game. Cut that one and move on to the next game. That's maybe a tennis analogy. I'm no tennis player, but hopefully that plays.
No, that's really good. I mean, it does help. I think like a skilled tennis player is going to know, if the ball's in a certain position and you're trying to return it, where the highest probability is, or you may have hit one to that spot and then been burned because the guy was ready for it on the other side. But
Right.
still, you got to know hitting it to this side. In tennis, the lowest point on the net is right in the center. So it does make a difference, even though it's only a couple of millimeters versus the end or the angles. Those things matter to know, hey, this guy's got the advantage on me, but I still need to most likely hit the highest probability shot, or the chance of this thing being a winner is really remote. I could make a great best shot of my life and win that easily, but not that easily. It's a really difficult statistic. So it just draws in my mind things like some of those big value comeback. Probably not. It's just a lower probability versus the things that are already working in the momentum cycle. That's just kind of how I think about it. But so thought I'd share
Yeah.
those thoughts with you for any tennis
No, I mean
players out there.
it helps. I mean, there's a lot of sports analogies you could make. I mean, you'd say, okay, well, do you want Josh Allen leading your team into the playoffs, or do you want my guy Derek Carr on the Saints? Probably not. For any of the kind of football junkies out there, we're not even sniffing the playoffs this year. Maybe in a couple of years we will. But the idea is, who's relatively stronger, Josh Allen or Lamar Jackson or Daniel Jones or something along those lines. The answer is quite obvious. So relative strength plays in a lot of different ways, and when you're able to make those connections from sports or wherever in your life, which tastes better, penne pasta or angel hair, right? Relative strength, that's the one you're going to order on the menu. That's probably a bad analogy, but you get the idea.
The stuff that's in season, right? You're
Yeah,
going to have the
exactly.
seasonal vegetables versus the ones that been frozen and out of season and flown halfway across the world. Probably is going to be a better formula.
Yeah.
What are there any other themes that are really emerging as we think about this? Aside from the fact that you have a very disciplined, robust process that, I follow daily and use that to communicate direction and ideas about what's actually happening on the playing field versus, what is supposed to happen. We actually have to look at the real plays. But any other big themes or just points of interest you want to call out?
Yeah, there's another development, and it actually works because it parlays in a few different asset classes, is going to be the strength for the dollar. And
Yeah.
so, we've seen the dollar move higher in terms of, its strength post-election, right? I think the idea is that rates might have to stay a little bit higher, which is, of course, going to attract international or going to attract money as people are looking for higher rates and higher yields on their investment. And so a higher dollar or a stronger dollar is going to be have impacts a lot of different places. You look at internationally, you have a weaker international market when the dollar is strong, right? Essentially, other countries' currencies can't go as far in US denominated currency, or they can't buy US products at the same rate that they could have prior. So typically a stronger dollar is a headwind for international equities. The same rule applies when you're looking at commodities. And so you look at US denominated commodities there, that's going to be inversely affected by a stronger US dollar. So a stronger US dollar is going to impact a lot of different places. Higher rates are going to impact precious metals and gold. So there's many different asset classes. I'll essentially let you choose whichever one we talk about next. But it all kind of stems from stronger dollars, stronger rates, and things like that.
Yeah, those kind of measurements are so helpful, or to know those relationships or correlations. I'm very mindful of that because we've watched the dollar, but what that does to international or commodities, how they may seem like a great buy, but maybe they're in an area to avoid until because that's just such a powerful factor. So that's a really helpful comment, something that's definitely been one that's come up and I've been thinking about a lot. So
Yeah, and China is specifically a point that, is worth watching. Of course, China is a big player on the international front in terms of its correlation with the dollar, very similar type of relationship. So dollar goes up. That's, of course, not a guarantee or anything that China goes down, but it's just kind of another roadblock in the space there. And of course, China is going to have an impact on your emerging markets funds, points of leadership within the emerging markets, within the kind of global economy as a whole. So it's certainly a wonderful game we're all playing, and a wonderful dance that we're all
yeah,
playing to see, where those points of strength are, and the dollar has a big impact. It hasn't trended very well over the course of the last few years, but if you go back in history, over the course of maybe the last 2 or 3 decades or so, the dollar tends to trend. And what I mean by that is, the stronger dollar typically leads to a stronger dollar. A weaker dollar typically leads to a weaker dollar. And so, if we're entering or re-entering a period where the stronger dollar leads to a stronger dollar, all of the stuff that I just mentioned before is gonna come into play, right? Weakness for international equities, weakness for commodities. So we'll just have to see. That's another thing that I'm watching in 2025.
yeah, I love it. It's such a helpful framework of how all these sort of asset classes or pieces fit together within the system. You mentioned China, and then, I mean, it is the second biggest economy in the world, but they were really, really struggling last year, and then they had that massive stimulus, right? They threw everything in the kitchen sink and a big rally. But
Right.
we kind of try and stay out of some of that fray, and most of our clients don't want to be there. But it is the second biggest in the economy in the world, and it does matter. And now the tariff question keeps coming up a lot. We really don't know where that's going to go, but that it does play in to some extent with market expectations and whatnot. So it really, really is a helpful to have this constant monitoring. As we release the podcast, you've just come out with a report, but this is stuff you're following on a daily basis, right? So you're watching the changes, what moves into a model, what moves out of a model, monitoring, dozens and dozens of models. It's a really helpful process to see what's continuing to work, what may be changing, what's weakening. I can't emphasize it enough for folks that we follow that. It's really interesting. It just helps put a process. It's kind of like the doctor measuring, blood work or other biomarkers. It's just a pure objective measure that we do routinely, and it just is very helpful for guiding folks, especially in an area of social media, network news, very, very media driven sound bites that are just trying to get people to respond and react. So any
Yeah, well, I
other,
mean, that's
yeah.
always our goal. That's always our goal, right? I mean, I come into the office every day, and I write the research that you put together myself and the team, and put together the report and monitor all this stuff because at the end of the day, it's something I enjoy doing, right? I mean, I've grown up. We talked last podcast about how I got involved in money and everything like that, but seeing my parents go through the GFC and things like that, you grow up in a very impressionable part of my life, and you say, okay, well, I want to help people out with their finances, right? And so we both do that in our own unique ways, but finding a way which we can help and really hone in on these points of strength, points of weakness. Hey, this is what we should be avoiding, in your portfolio. You can only think about how much that does for our clients, and ultimately the end families that are better off, because you say, okay, well, we know what points are weak, we know what points are strong, we know we need to be in cash right now. So that's a bit of a soapbox answer, but it's all nice to help out. That's the main goal.
I agree completely. It's really about helping folks. And so we're trying to do that every day and use this info. It's extremely interesting, but it gives us a lot of clues and guidance. And I mean, I just think could you imagine trying to do it or understand what's going on in markets in the world without this? I mean, I think you'd be at such an enormous disadvantage, but I don't think people necessarily see that lens that we're always looking through, or those multiple lenses. But can you imagine, or how much more challenging do you think it would be to figure out stuff in the absence of this?
Yeah, I mean, that's not even a question. I mean, it would
Right.
be almost impossible. I mean, technical analysis gets a bad reputation nowadays because of, the TikTok stars that are trying to turn $100 into 2,000 by looking at a 30-second chart and all that type of stuff. And I'll let them do their thing. But the idea is that how well can you kind of separate yourself from that? Think and prioritize the long-term health of your portfolio and things
Yeah.
like that. It's not just about what you can do in 30 seconds with your money. It's what you can do in 30 years with it, but by staying kind of time tested and truly systematic about your investment processes and stuff like that.
Yeah, that is such a perfect summary, and we're totally in simpatico. The title of the podcast is The Millionaire Next Door, kind of thematically the overnight 25-year, success story. It's all this stuff, we're in partnership with clients to help them, but we see all this, we try and explain it. I think at the end of the day, most of them get that we have a very disciplined, refined, robust, objective, unemotional process, and that we can put that to work for them. But I really appreciate your partnership in this, and we're going to have you back for sure as kind of a regular and recurring guest. That would be my goal if you're up for joining that ride as time permits.
Oh yeah, of course. I
Yeah,
mean, every quarter we're going to put out the quarterly report. I
great,
mean, if it needs to be around the quarter, I'm happy to come on or not. It doesn't really matter to me. Whatever. We could do it weekly.
great,
It's plenty
Miles.
fun. But just
Great.
yeah, anytime.
Great. No, that's fantastic. Really appreciate it. I'm glad to give you sort of a final closing thought. But again, just thanks for coming on. We're following this stuff all the time. We're trying to share it with clients for the betterment of their portfolios, for their lives, for their goals, their dreams, to figure out what's going on, with their, precious capital. But if any closing thoughts, otherwise, we'll wish everyone a incredible 2025 and New Year, and really great having you here.
Yeah, I mean, same exact idea. No major closing thoughts. I think we did a pretty good job of hitting on everything. But again, it's been a pleasure, of course, and everyone listening, I appreciate your time letting me speak, and of course, it's always a pleasure being on. I hope everyone has a wonderful 2025, and please be safe out there and have a wonderful year. I'll see you next time.
Yep. Thanks again. Happy New Year, everyone. Be good. Bye for now.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities LLC, member FINRA SIPC. Investment advisory services offered through SEIA LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.